Hello, everybody. Today is the 14th day of December. This year is almost over. Pretty crazy. Wanted to chat with you a little bit today. Probably will be a little bit longer because it's been difficult for folks this year to understand what is happening with the markets in general. It's sort of a tale of two different cities, if you will. You have some parts of the market that are crushing it, mostly technology, but not entirely. And then we have some parts of the market that have really had a hard time over the past 18 months. So what has worked great. What hasn't worked, you're going to see more of that as we get into the next few months, I guess is the way to say it. So let's go to a chart, because I can't stand it if I don't do a chart. Don't laugh at me, but I like them. And it seems to be something that we can use to illustrate my points. Okay, so what we're looking at here is the Standard & Poor's 500 index. The Standard & Poor's 500 index is not an equally weighted index. Now, what that means in American is they don't take the value and divide it by 500. What they do is they weight it by market capitalization. So all of that said, what it really means is these top companies govern a lot of what has happened here. So you're hearing right now that Apple is almost a $3 trillion company. So what that means is that it garners over 6% of the S&P 500 from a weighting standpoint. So just understand 6.2% is Apple's weighting in this index. So it's not equal. You know, there'd be about 3,100 or more if we had to do that times 500. So it's not the same as the last company in there. So these top companies are driving this index. It's not as pure as probably what your brain thinks it is. Next up, here's a real thing that we need to think about. When you look at what's happened in the stock market and you say, okay, this has been great. Why, Craig, have you not put me in 100% S&P 500? Well, one of the reasons is you're buying really just those 5 companies for a lot of it, almost 30%, 28.5 to be exact, is the top 10 companies in that 500 index. So the other part is what's happening with money supply. So let me switch over to that. Hang on a second. Let me find where my little gadget here is. And what we're seeing here is the Federal Reserve Bank's money printing, for lack of a better way to say it, and the S&P 500. So if I've done this well, you're seeing something that says figure 1, Fed balance sheet versus the S&P 500. So the expansion of the currency, most of it held at the Federal Reserve for this expansion. You know, this is them issuing treasury bonds, and this is what the asset that you're seeing on the balance sheet for the most part is. And then you're seeing this blue line right here, which is the actual stock market. So a fairly concise sort of thing until we get right here, and then it gets a little choppy. That's, I think, 2018 or 2017. And then all of a sudden, what happens right here when the market declines, what did the Federal Reserve do? They printed more money. They injected that money into our economy, and it has been inflationary. So when you look at the stock market and cash or currency creation, those two coincide a great deal. So as they continue to expand the balance sheet, meaning print money, you probably will see more inflationary impact, meaning that stocks will go up because they respond to supply and demand. And if there's more supply, you know, and it makes the price go up, supply of money. So as we look at other things in here, just be aware this is kind of manipulated, for lack of a better way to say it. This is not an organic growth of the stock market where we're just doing fantastic and great. All right, let's switch back to my charting here so I can get a couple of other ideas in here before I get too long in the tooth. So that's been awesome. How have other countries or other parts of the world done in comparison to us? Not so hot. So that blue line that I just put up is an index. It's Europe, Australia, and the Far East. So Canada's in this index. All of the European developed countries are in here, not Russia, but you know, the Great Britains, the Germanys, the Frances, all of that. So you can see that there was an inflection point somewhere right in here where they no longer kept up with us. They just didn't. So that's Europe, Australia, and the Far East over the last 5 years. By far and above, that 500 companies in the S&P 500, especially the top 10, have done exceptionally well and much better than Europe, Australia, and the Far East, which is developed countries. Emerging markets. So when you look at emerging markets, what is that? Well, Russia, India, China are the biggest components in there. Probably China is the biggest component in that particular index, which is represented by that green line there. But just understand they're sort of at the same place, both of those indexes, while the US S&P large company, mostly growth index, has outperformed them. So this is but one asset class, the S&P 500. It's not a mine's better than yours. To a large extent is we printed a whole bunch of money and we're able to inject it in our economy and stimulate our economy. So be aware that these high prices do not last forever. Depending on how your money is being managed, you could have pure exposure to this index and you probably are saying, gosh, I wish I had that. But the other part of that is, please understand that when markets correct, or if there is a bear market, there's a lot that can be taken out of the S&P 500 relatively quickly. When people feel like their money is threatened, they'll sell, and it will be sort of across the board. All right, let's also compare this to the bond market, because most of you out there do not have pure stocks. High risk, it's been high reward here lately. So let's compare this, say, to the bond market in the United States, the ag. So this little blue line that popped up down here is the bond market. It's been stable in comparison to the S&P 500. There's not a lot of yield in here right now. Let's see what the ag yields. So it's yielding less than 2%, about 1.77%. Now, when I get rid of the S&P 500, it looks a lot more volatile, doesn't it? That's a 5-year window, looking backwards, of course. And so you can see bonds have started to decline in value. Why? Because anticipation that the Federal Reserve will bring interest rates up over the next 2 years. And so that's what's happening there. So S&P and the bond market, as that takes in treasuries, mortgage backs, and corporates. So that's pretty much the whole bond market. If we separated that out, you'd see that probably corporates, I can compare that. Corporates have done a little bit better. High quality corporate bonds have done better. Okay, not amazingly better, but better. And if you look at high yield bonds, you know, it's like I said, a tale of two tapes there. High yield really hasn't done as well as the bond market in general, and neither have done as well as high quality corporates. I guess I'll add treasuries in there just so you can see how all of them work. So I'll do 7 to 10 year treasuries as an example, and that's that pinkish sort of line there. So nonetheless, all of this squiggly bunch of lines is telling you that the one shining star in here has been the S&P 500. But I caution you, looking backwards and saying what has worked will work, I don't know. So inflation is driving a lot of what's happening. Bonds are not going to keep up in an inflationary environment. Just kind of keep that in the back of your head. Now, the other part is, what about things that could inflate? So we're looking at, I don't know if I have a 5-year window on Bitcoin, but I have something I can use as my proxy. Here's gray Bitcoin. So gray Bitcoin Let's see what we got going on here. That's great. Bitcoin. Where's my S&P 500 index? Oh, look at the S&P right here. Let me bring it to 2 years because that's probably when that would show up. So you can see Bitcoin versus the S&P 500 has really gone up a lot, hasn't it? Pretty volatile. So it's gone from up 550% to up 175%. So that's big swings in this particular type of investment. Whereas the stock market, although great, has been nothing like this. So there's a whole lot of new rich from Bitcoin. There is. All right, so let's look at gold and compare it to the S&P. So I joke, the old person's Bitcoin is gold. So there is gold, that blue line showing up against our stock market here in the US. You know, if you compare it, say, to something different like the emerging markets or something, you can kind of see gold has hung in there pretty well against that stock market index. Gold has hung in there pretty well against Europe, Australia, and the Far East. Better, because it didn't really have a significant decline, but nonetheless, nothing like this Bitcoin. So we'll have to see if that's something that will last forever. But right now, pretty darn amazing, just crazy volatile, or as one of my buddies said, wild, wild west right now in cryptocurrency. So I guess this is a little bit of a cautionary stance that I'm taking today, saying beware that over the next few months, 6 months, 8 months, you'll probably see more and more volatility as the markets start to move around, adjust to extremely high prices. Saying what happens is that, you know, eventually the inertia of this huge move that we've had will slow down, and you'll see the market start to drop back down to a more realistic valuation of prices. I looked at a research report from Vanguard, and Vanguard basically is saying that the next 10 years are going to be mid to low single digit growth across the board, with really emerging markets and Europe being the better performers versus large cap growth, which is where everybody's had their money for the most part this past 2 years because of technology. So be advised that what we've seen in the past may not give us the same returns if you're trying to stay in that one asset class, which is the S&P, or even more poignant in the technology space. They're great. I'm not saying there's something wrong. I'm saying they're very expensive. So two stocks that I'll give you, NVIDIA, which in the stock portfolios that we run, we've had that. But you can see NVIDIA went up to right here, NVIDIA went up to about $346. So it can go down too. It's 274 right now and dropping down to what is its 50-day moving average pretty quickly. If you compare that to Verizon, which is not the same, but a different kind of company, you can see Verizon has the chart pattern of a flight path of a brick. I mean, it's going down. So although fabulous company, a lot of people like that 5% dividend. Well, it wasn't 5% up here. It was a lower dividend because the price of what you bought was higher. But as you can see, the price of this particular stock not going up, although a great company. So you go, some of this is really working, the hot stuff, because we're melting up right now. But the other side is you're seeing more kinks in the armor, especially in the large cap growth space, because they're just very expensive, and people are saying, how much more can this go up? So that's my little cautionary stance for the end of the year. As we get into next year, we're going to be doing more education. We're going to be doing some pieces that we'll be offering to you. We'll call them 101s. Those will be the more basic courses. What's a mutual fund? What's an ETF? You know, why would you own one versus the other, and those types of things. We'll talk about bonds, we'll talk about stocks, those types of things, and try to get you educated. And then we will work a little harder on some of the other educational pieces about retirement planning, investment strategies, and different things such as that. So I hope you're going to have a great Christmas, a wonderful new year, and I look forward to talking to you as we develop these strategies out for you and make it a great end of the year.